All right, greetings everyone. Hope everyone is doing well. We're almost close to 4th of July weekend, which tells you we're at the midpoint of the year, and what a crazy year it's been, right? We've seen a business cycle end. I believe we're at the beginning of a new business cycle. The impact of this has been global. And so this is a great time to sort of go back and look at data across the world. And this is something that I do on a monthly basis. And the point is not to base investment decisions off of macro data, but to understand where we are in the business cycle. And it provides a lot of great context, right? So let me launch my screen and we'll get going. So here we are, it's macro around the world. And let's start with the disclaimer. Since I've already paid, my lawyers, let's go back. Since I've already paid my lawyers, I might as well show you this slide. Anything and everything in this video is for educational purposes only. If you have questions, please reach out to me. My information is right here, latticeworkinvestments.com. And since China was the first one to shut down and the first one to reopen, let's start in China, and let's start with auto sales, right? The Chinese auto market is the largest market in the world. It's about 25 million annual sales in units. The US market is about 17 million, so quite a bit larger. And as you can tell here, March was down 80%, and now we've seen a rebound where actually May is now up 7% year on year. So very sharp decline and very sharp improvement, right? So part of that is pent-up demand. Part of that is added sort of financial availability, but we'll find out how sustainable these numbers are. But before we go forward, I want you to kind of look back here. The market was growing very, very well for many years. China actually starting to tighten its economy back in 2017. And you can see this number going down. This is a trade war. So you've had weak sales for multiple years. And this kind of means something as we see some other slides, especially in Europe. So let's go to Chinese export orders. Again, a big drop off early in the year. We're starting to rebound nicely. Below 50 is decline, above 50 is growth. So you can tell the numbers are improving, but they're still negative year on year. And part of that is the rest of the world opening up obviously is good for Chinese exports because they depend on those things. All right, so here are Chinese retail sales. They've been growing, high single digits for many, many years. Of course, you stop an economy, everything stops. You saw retail sales decline about 15%. Now they have improved to still down 3%. The one thing to notice here is clearly China is a very large e-commerce market. So having that availability and that avenue to sell is very beneficial to most of these companies. And as you can tell here, these are comments from Nike from a few days ago. Their business in China returned to growth in the last quarter, but that's not just because retail is growing. It's because their digital sales are up more than 100%, which has really been kind of consistent across the board. This is Macau. This is one thing that has seen no improvement, right? And part of that is because there's a 14-day quarantine for all visitors coming into Macau. So clearly nobody's going there. It's all locals, and most of the casinos are effectively shut. So sales are down 97% June of this month over June of last year. So absolutely nothing going on in Macau. Chinese air traffic, now these are numbers off of April, so a little bit dated, but air traffic slow to rebound, still down 65%, and this is domestic air traffic. Total air traffic, which includes international, is I think down 70. So not a surprise, right? Again, they're all, I guess, using Zoom also. Chinese leading indicators, dropped pretty hard as everything was shut down, have rebounded very well, and I expect them to be above 100, which means growth sometime in the second half of the year, at least based on all the other stuff we're seeing in China. Now let's move over to South Korea. This is the semiconductor manufacturing hub of the world, right? So even though some of these economies were fine, there were no exports. And now we're seeing, June numbers back up as a lot of those supply chain bottlenecks have cleared up. This is the Japanese composite. So this what tells you, even though Japan wasn't one of the countries that shut down, the impact is literally about the same everywhere, right? You've seen bad numbers, and now you're seeing a rebound even in Japan. This is the Japanese business cycle. So it's a composite. It's showing you things are pretty bad. That's what you'd expect. And now the question is how fast and how hard do you see a rebound in the second half of the year? Same thing with the Indian business cycle. These are the leading indicators. Again, you've seen a decline and now a slow recovery. The COVID situation in India is actually probably worse than in most places. So as you can tell, this is the composite PMI, manufacturing as well as services, and this is probably as bad as anywhere else. This has gone from 60, so below 50 would be contraction. 10 is very, very deep contraction. Now some rebound off of that. Just to wrap up some of the Asian stuff that we've seen, the Chinese market has been the best market. It didn't really drop as much, and it's down about 2% for the year. The rest have done worse. Of course, India is the worst one, down 15% in Asia. Nikkei and Taiwan are down, a few percentage points. So let's move over to Europe. This is the Eurozone composite PMI. As you can tell, very, very strong rebound in the month of June. And part of this is obviously associated with the rebound in China, if you remember the auto sales. So auto sales rebounding there helps here. But again, Europe is reopening, and the number of cases, if you want to call it the second wave or the continuation, has been still pretty low and controlled in Europe. This is the Eurozone LEI, and this is a much longer chart, as you can tell. This is about going back to 1987, and what it's telling you is things are just bad now as they were. This is the European crisis, but not as bad as 2008, which was worse in most other places. So you should expect this thing to start to move up sometime in the second half. Right. The one thing that I missed was German manufacturing. Same thing, Chinese auto sales, a rebound in China helps Germany because that's a very big trading partner for them. But again, you're starting to see this rebound, still shrinking, but better. So there's a recap of Europe in the first half of the year. Pretty much a synchronized drop in that mid-February to mid-March. Every market dropped about the same, dropped about 35%. And since then, the German rebound, as you see from the DAX, has been the strongest. The DAX is now down 6 to 7%, and Spain is down 25%. Part of that is a much bigger fiscal response and monetary response in Germany. Now let's move over to the US. Let's start with the US CEO confidence. And when I look at this, this doesn't look actually anywhere as bad as I would have thought, right? So this is the Brexit impact and also a little bit of a recession, or mild recession in the US. So the CEO confidence was much worse back in 2016, was much much worse in the summer of last year during all the trade conflict. And now it's declined, but it's not as bad. It's over-indexed to bigger companies and who have deeper pockets. But as you see, once you look at US small business CapEx plans, I mean, they're looking much worse because smaller businesses don't have access to the same type of financing, et cetera, and the resources that bigger companies have. So this is a lot more challenged, and this is probably more important to the US economy. Small businesses are. So I'm sort of curious to see how this chart evolves over the half. This is US manufacturing making a very strong comeback, I think. Two different lines, two different measurements. The white line is more global. It's the ISM manufacturing. The dark blue line is more domestic. So you can see a much bigger dip, but both are now responding much faster than you thought. This is the services PMI. Again, the same type of dip, rebound. Again, remember, services is much more hard to control. Manufacturing, much more of a controlled environment. faster to come back. Services is harder because it's more people contact, but still rebound. Next thing is U.S. retail sales, very sharp drop, almost 20% in the month of March and April, and now we're rebounding. The month of May was actually very, very strong. Part of that is, again, reopening, stores just being open for business, and the stimulus checks that went out in the middle of April. So those things have helped in retail sales. And within retail sales, I wanted to point out e-commerce. E-commerce has been growing strong. We all know that, and we know it would benefit from the current situation. But look at the acceleration in sales. The blue line is year-on-year sales improvement. March was up 14%. April was up 22%. In May, even though stores were open or had a lot of the stores reopened, May was up 30.8%. So very strong e-commerce and a lot of sustainability there. New building construction permits, this is an important part of the U.S. economy. Slowed, dropped in March and April, and now we're seeing a rebound in May. Again, the summer months help because seasonality outside. So this should improve during the summer months. Now let's sort of walk through a lot of the leading indicators, and they'll paint you a very similar picture that everybody's at a trough and everybody's slowly improving. The rate of improvement will depend on each economy, right? So this is the LEI leading indicators. Look at a lot of forward-looking data like permits, stock market, yield curve, those kind of things. A tough last few months, a little bit of a rebound. But if we take a longer term look at this, where we are today is very similar to, this is the 1990 recession. This is the 2000 recession. Of course, 08 was much worse. So we're sort of at that point. And as we normalize, as things improve, we'll have fits and starts based on the number of cases. But this will sort of start to improve in the second half of the year, or it should. Here's a chart of the yield curve. These are two different yield curves. I don't want to get too caught up in the technicalities, but generally, long rates fall below short rates. Things tighten up, tells you economy slowing, going into recession. The Fed comes in, cuts short-term rates, and now slowly the yield curve turns positive because now short-term rates are below long-term rates. And that has its own sort of impact because that helps banks lend more. And then you start to see this feedback loop. And it happens every time you start to see the yield curve start to move up. This recessions end, economies improve. And we're sort of seeing the same thing right now with the yield curve being in positive territory. Continuing jobless claims, and I want to focus on the continuing instead of just the initial jobless claims, because we already have all those folks who have been furloughed or laid off in the system, and now we want to keep track of who's coming back to work. So you're starting to see this number go down because those who are on the unemployment checks are now going back to work, and we want to keep track of that. Again, it's going to take many, many years, and I don't know if we'll ever get back to the 3% economy we were, but this is a good sign. These are credit spreads. So we are trying to track the cost of borrowing for less credit-worthy borrowers, right? And you compare that by comparing that cost to just government bonds. And as you start to see this line start to move up, it tells you that there's a lot of stress building in the system because the cost for these less credit-worthy borrowers is starting to rise, right? And it's a negative signal. It tells you things are not as good as you think. So you saw this thing peak in April, and it's sort of normalizing. We might get another bump up, but that's expected. And this is very similar to that. This is investment grade versus government bonds. And it shows you the same thing, stress building the system, and then now things normalizing. This is the Chicago Fed National Financial Conditions Index, a lot of words, but really shows you the same thing that we saw before. Line goes up, financial conditions are tightening. So a Fed comes in, pumps a lot of money in the system, financial and monetary fiscal stimulus, and now we're starting to see the tightness go away and things to normalize over time. So look, that's well, we've gone through a lot of slides. This is the slide number 35. So that's macro data around the world. And I think what you can tell is that generally speaking, the data looks very similar across the world, right? Whether you shut down or you didn't shut down, the numbers very much look the same. The cadence of the drop looks the same, and the rebound generally looks the same. But what all that stuff's telling us is that the worst of the pandemic is behind us. And from here on out, really the rate of growth will depend on each individual situation of the country based on the number of cases and how things evolve. But the other thing to remember is the fiscal and monetary stimulus, how early it came, and just the significance of it is something that you cannot ignore, because I think from, if you've seen one of my previous videos, the total stimulus is about 6 or 7% of total GDP, global GDP. So it's a massive number, and all those things combined, I think we should expect the data to improve over the next 12 to 18 months. So that's all I have. Hope you enjoyed the video. If you have any questions, please reach out to me, adesai@latticeworkinvestments.com, and have a great 4th of July, everybody. Thank you.